Hi everyone and welcome. I'm really enjoying doing these videos for you, even though I've only done 4 or 5. I really like looking at the markets on a macro level weekly basis down into the daily and 4 hours. So we can get into it again this week with our usual dollar and pound euro analyses, metals, indices, soybeans, and Bitcoin. So hope you enjoy and we'll get into it. Okay, so here we have the dollar on the weekly chart, and as you can see, we had a pretty indecisive week with a consolidation and a very small range compared to last week or 3 weeks ago, really. And I think that was mostly due to the lack of news coming out, at least red folder news. And we could see, with how things go during negotiations with Iran, we could see this next week really go somewhere. I do have an alert down here at 98.5. I'm kind of hoping we get a depression at least to take out this low from last week before we start to shoot higher. Anything's possible, but that's basically what I'm looking for on the dollar. I'm not necessarily, it's possible that this is a weekly tap of this high from this candle here. So if we were to draw a ray over here, it pretty much tapped it right on. So the high on this candle is 98.939. The low on last week's candle, 98.944. So 0.005 from tapping that candle here. So I would like to see another push below last week's low before we head higher, but it is possible that we don't and we just kind of wick into this wick and continue upwards. From the range perspective, we are right at the 25%, the upper quadrant of the range here. So this is typically, from a dealing range theory, where you would expect another launching point or a gap to form. So here, if we look at the 75%, the lower quadrant, extreme discount, we took a huge push up. Okay, we pushed through the 50, came back to the 50, and really haven't had much of a body close below that except for this gap down and a mini bearish candle here, which I guess was a surprise and scared me out of euro 2 weeks ago. To basically give some of this imbalance here from the start of March, when the war started in the Middle East, to maybe give that some more volume, right? 1, 2, 3 wicks, and then we took off. So another explosion off the 50. If we're looking at this dealing range, another explosion off the 75 would be imminent in my perspective. We could consolidate still a week or two. This week is also pretty light on news, but that's what I'm looking at on the dollar at least. If we shift over to the euro, now here we had looked at a couple scenarios on the daily time frame. It looked unlikely, again, from our analysis, that we were going to shoot past this whole range here, this distribution. And I do still see that as fairly unlikely, but it is possible still. So I think we could almost just take these two and slide them on over here. That is one possible scenario. We really didn't get too much action. We had a up day Monday, down day Tuesday, and then just a bunch of consolidation. So this almost just plays out exactly the same way for this coming week. I think we can have a very similar forecast. I would like to see, again, to be able to wick through the dollar's last week's low. I'm pretty sure euro will have no problem taking out last week's high, which is right here on Tuesday. And so I would expect to see that happen on euro before any significant move to the downside. We do have this daily inversion fair value gap here. There's no gap on this side, but there was the gap on the way up to kind of finalize this stop run up here and then take a tumble below. So while we've now consolidated inside this gap here, and it would be good to see just a liquidity grab and a drop. So I'm expecting more of this middle scenario to play out on euro over the week. If we move over to the pound, so here we did expect that might be one of the scenarios up and then begin a push lower. So the pound actually had started this and has consolidated within this range, the weekly gap here from 3 weeks ago, I think. So we've been consolidating within that gap, which makes sense to give that some volume. If it's to play out similarly to the euro now, I think we could basically just grab this guy and slide it over here. I would probably be looking for something more like this, where we tap this imbalance and then take off to the downside. If pound is going to show any correlation with euro, then I do think we would probably be seeing some kind of manipulation upward. It's possible that pound won't take last week's high, but I don't see that as very likely. I think both of them will take a high, and they may form an intra-week divergence. So we could see some SMT there between pound and euro, or even the dollar index, right? The dollar may not take last week's low. If we do go back to the dollar index, it's unlikely but possible that we don't take last week's low with the wick, right? If we look back at the weekly. Now looking at the daily, it looks very improbable that these flat lows with an imbalance below it doesn't get grabbed. So if we take a 2-week dealing range here, it's highly likely, I think, that we at least plug into this 382 mark and likely lower to the 50%. That would overlap some of these wicks to the upside. But again, this is a much smaller dealing range, so I would expect to take last week's low, dig into this imbalance. We do have this down candles imbalance here as well, so that is a possible point for inversion if we are to look at this. So below 50%, right into this sell side imbalance that only has a wick here and a wick here, so we might just come touch the premium high of that and take off. So I'll be looking for earlier in the week euro pound to manipulate up, dollar to manipulate down, and then extend to the upside for dollar, downside for euro, and for the pound. That is the forecast on those guys. For gold. So gold, we were expecting last week to have a displacement through this 50% mark, which we got on a 4-hour basis. It retraced and then did it again on the daily time frame. So we do have a nice red candle close through the 50% mark of this dealing range. And we are still below the 50% of the parent dealing range. So this is still bearish for me. There were some tempting longs here, and I actually did take a couple longs that were mostly break even. I was just thinking, watching the silver chart, watching the copper chart, it just seemed impossible that we weren't going to go and sweep these equal highs here. But on a 4-hour time frame, it looks even more enticing. For like, once this started, you thought, okay, it's just going to sweep that and come back down. Well, it never did. Silver and copper certainly had much of a silver actually didn't either. Copper had the biggest push there, and so it actually did start to dig a little bit higher into this, nice inverted imbalance on this side. So while copper continued to show strength, silver and gold pretty much consolidated for the week and were pretty lackluster. This nice 4-hour, I saw this and I got really excited, but again, with the lack of news last week, this was certainly a reason to continue to stay bearish, even though this past week on a 4-hour basis, really there was plenty of choppy movement, and one could take advantage of that. but on the for the most part, we're going to have to wait at least this week, possibly into next, where we're going to see hopefully a manipulation up and then down. I think gold looks a bit more bearish than silver, although silver can certainly have a faster swing, a more volatile swing than gold sometimes. But you know, you can just see this market maker sell model right here. We've got the consolidation, a push up, consolidate, push up, reverse, first stage of distribution, consolidate, and we should get a second stage of distribution to push us down really below these lows for sure. This is very low resistance on a liquidity perspective, right? If we do take, I'm going to go back to the daily here. So on a daily time frame, right, this dealing range, we can see that the 75%, the lowest quadrant, ultra discount, is resting below these lows and below this low. So we can certainly see a push down to take out this low here, and by most calculations we should want to get to an extreme discount in the lowest quadrant of this dealing range. So that would put us below these relative equal lows, and there is a bit of an imbalance here from a long time ago, back in December, which has been tapped for sure, but that could still be a sensitive area right at this 75 mark, at the lowest quadrant premium. So that's what I'm seeing on silver. I think we're consolidating. I'm hoping we get just a wick up and close back for a day, and then we're off to the races to the downside. Keep in mind that the metals do move a lot, maybe in the overnight session, so you may not get opportunities in New York, but that's, you know, at least you can use a daily wick and close back below this mark to, you know, help your analysis and figure out a lower time frame point to get in. On a 4-hour perspective, yeah, silver's really just consolidated all week, and it's possible that it just dumps. Again, macro-wise, I'm looking to accumulate more silver down here in the 55 area, 55 to 60 area. That would be more aggressive. It's possible that it gets there again. We went over that last week. It's possible it gets down here, but more likely it will tap into this 75, consolidate. It might sweep this low at 61,210, and then I believe we are going higher. Copper is showing a lot more strength than we anticipated from last week. So if we pull out last week here, it really did consolidate, showing a bit more strength than gold and silver, but I do think we're still on the downside here. Again, we have this big imbalance, we have this imbalance that formed a balanced price range as we went through last time, so it is likely to come take this low out and get right into the premium high of this imbalance. So again, these all can probably just move straight over here and I think we're looking at something like this for copper in the coming days and weeks, where we can certainly be taking out these lows into this imbalance and most likely this low and hit the premium high of this imbalance here, where the down candles before the break of that occurred. So we're likely to touch those levels again beyond just this one point, and then we'll accumulate more copper and head up. Right, oil. So oil has been interesting. I'm going to turn on B adjust for a second. So we did have a nice down week in oil to kind of correct for some, at least rebalance some of this price action to the upside, and that was fairly expected if we weren't going to bust through this high yet. And with all the non-news coming out of the Middle East, it could certainly give oil a chance to rebalance some of this premium pricing in here with some sell side. And now we're back below the 50% of the non-adjusted dealing range. So we are below the 50% of the non-adjusted dealing range. I'm going to switch over to the current month contract here, right? So this we went over a bit last week too, where I was long from here, I think, or here, and we pushed up. And I actually have another video on this where I was long the June micro contract, and you can read all about that or look at my dramatic video about that, but I let it expire by accident. And I actually had to call my broker, who advised me, thankfully, that micro crude is settled in cash, not in oil. So that was a scary lesson for me to remember my expiration dates. But I was wondering why I hadn't gotten a call from the broker saying, hey, you have a outstanding contract that's coming up for expiration, you need to close it. All of a sudden I went to place a market close order because I thought, oh, this is a good, we broke this high, and I went to close it on Tuesday right up here, and it said market order rejected, contract has expired and cannot be traded. I was like, oh, scheisse. And so that was a bit scary. I did not want to take delivery of oil, but turns out I didn't have to. So the next few days we took a run down, and I think that's good. We certainly wicked below this low, and we're seeing that a lot. We have this kind of a low in the midpoint of the dealing range, and we come and take that, right? So it's certainly possible that we do continue down here if we mark this dealing range. We have not closed below the 50, but it's highly possible that we wick down, give some more price action to this gap here between Friday, May 8th and Monday, May 11th. So we could give some wick action to that in oil, and I'd be looking to long really anywhere below this gap if we are to keep closing within it, below this inversion fair value gap. Or if we're going to stay in premium and really launch, then that's where we're going to be. So I'm looking longs for oil, but we're still in a bit of a premium market here. And honestly, oil's been a good, correlated and inversely correlated asset with the indices, with gold and silver, somewhat, but with the indices for sure. I mean, I pretty much, as bearish as I want to be on the indices, I was seeing this in oil. I was seeing the indices sort of forming an accumulation bottom, and ended up having to long the indices at the end of last week. I thought we were going to take all-time highs, but we did not, except for the Dow. So it could be a bit of a consolidation here in oil and in the indices where we are, but we'll get to that later. I'm still looking to long oil and short indices in the very near term for a longer term trade, and we'll see how that goes. On the 4-hour time frame here, right, we have closed just above the 50% of the stealing range. So it does look like this is a bit of a market maker sell model to come and take out this low and get into this gap. So that would corroborate bullishness on the indices to kind of take out their all-time highs again before a run down. And to be honest, it makes sense with a double top, and we'll see where that is. This would form a double bottom for the oil, and so we could get to the lowest quadrant here, the 25%. But this is where into this gap right here is certainly good enough. It's below the 618. So when we have a break of this high, a tap, another push to the upside, and then a double bottom somewhere in here for this week on a 4-hour basis, that's what I'd be looking to long to continue to the upside. Here are our markings on soybeans from last week, and so we are still expecting, I think, a bigger push down to then take a shot up to attack this high and this high here, kind of all in one pool of liquidity. So we could get once we're up here, we could get a massive blast through if this is to play out. Again, we did run this trend line, and I talked a bit about trend lines last week, so you could check that out. Why do we draw trend lines? I mean, I usually don't, but you can use them for a couple reasons, and this would be one, to show that there's a reason we can draw trend lines, but I would think if we're going to come to an extreme discount of this dealing range and a somewhat discount range of this leg, then, you know, this trend line has given us a confluence with this gap to possibly have a long entry point, a very low risk long entry point here, right? And I think we've started to see that. We saw a breakdown, and now we're possibly looking to continue downwards on soybeans. And so I was short soybeans for at least this run from Tuesday through Wednesday, and then I got out at the middle of this gap thinking we're probably going to bounce, and we really didn't much, so I just stayed out of it for now. I'm going to see how early next week starts, if we can take one of these Thursday or Friday highs. That's why I have a couple alerts here, and get into this imbalance. So there is an imbalance here, an inverted imbalance, and overlaps with this gap here. So if we can push up, I would expect another big drop to come down here, which would align potentially with other commodities going down, so gold, silver, oil, and the indices rising. So, you know, in the short term, it does look like the negotiations are going to be the news catalyst to give us a run down in commodities, and everyone can say, look, prices are coming down, you should be happy. Well, we'll see. I do think it's going to be a nice manipulation below all this sell side liquidity that is just waiting. You know, it doesn't have to be tapped. There was this wick down here right to the almost to the 50 mark, but this consolidation in a premium market is pretty much going to get taken, and it may get taken after this high gets taken out or swept, but before any real appreciable run up, in my opinion, this has to be cleared, and it has to be accumulated. So this has been a fat accumulation over like 2 months almost, to just wipe it out and then run up to the highs. So that to me makes a lot more sense. This double top is too clean to just stay as is. So we're in this range until one side of it breaks. I do think the top's going to get broken first, but it's going to make a big hefty run into discount here between at least the 75 and the 50 to get some rocket fuel to head up. Soybean oil started to look the same way, so we did take out those relative highs and headed our way to the downside. So we talked about this last week. I did want to see a purge of these relative equal highs into this inverted fair value gap, and we did exactly that. We wicked up, and we still are now closed below the 50 of this range, and all these sell stops very similar to the soybeans. I expect to be completely rated, and we could be looking much deeper than this trend line on soybean oil and begin the start of a new trend line, perhaps. I mean, if we are to modify this maybe to here, and we draw it with that, you know, somewhere more like that, where now in this dealing range, now we'd be in a discount. So if we were to come in here and tap below the 50% mark, where there is an imbalance, there's an old high, there's a gap down here. So this 75% basically marked the down candle after a gap, a down candle up with a bullish engulfing through it. We came back, tested it, and launched from there. So this is a indicative valid dealing range with a close through the 50, consolidate, push off, and then a final push off the 75 mark into the apex, consolidate around 75, take some equal highs to dump. So we're going to come down here most likely, and I'll be looking for it to take maybe Friday's high into maybe a premium at the 50 mark here at 75, 74.98, and drop. I mean, it's possible we don't even do that. Possible we can just tank here. So the analysis on soybeans and soybean oil continues to be shorts until we're in a discount of below 71.25, and even that might be a risky long, but I think we're, depending on how the cross-market analysis goes between soybeans and soybean oil and other commodities, this could be the bounce point here, right in this imbalance. And that's what I'd be looking at if we redrew this new, more recent trend line to kind of align soybeans, that trend line, right? Looks a little more like this. So soybean oils had a bigger run up, so it had a more aggressive trend line on the from this one that we modified, and I would see us breaking that, and that's where you could have that trend line, the aggressive trend line, and then we could break it, retest and come down, or we break it as a false breakout down and continue up. So that's what I use trend lines for, is really to think maybe more like retail, and see what they're seeing and see why this would hold for one more 1, 2, 3 taps, right? It might break, retest, and then shoot up as a false breakout. So I don't use them as like actual chart patterns, but I can use them as reasons for where price might want to go to knock retail traders out, accumulate as institutions, etc. Okay, indices. Here we have the ES again, and I think we can more or less do the same thing here on the weekly basis. So we did not extend the dealing range yet, and as much as I thought we were going to on Friday, I have another video that I'm going to put out later that will explain why that probably didn't happen. But for now, on the daily time frame, this, as I explained last week, and there is a lengthy explanation, the dealing range here was not breached. It still looks very valid as a dealing range. What I see from last week's consolidation and push up, again, there was light news, so we did fill in the ES on this inversion fair value gap. It's almost impossible to have a blow off top without, at least a retest. So I would have expected a retest. And here's where the dealing range theory gets a little more interesting, right? So if we are to take this week and spike through here and close back, this still remains the valid measured dealing range, and it would basically just be a sweep of liquidity on this high to form a breaker, right? So if we do see that, I would expect to see this happening. It would shoot through and close back down, and then we would be breaking this low, and we'd be forming the breaker pattern: high, low, higher high, and then a break. So we'd start to get the ICT model 2022 unicorn, where we'd want to see a retest. So if I am to draw that just really fast here, we would have some kind of a possible consolidation here, but I'd want to see a wick through with then a wick back, and we'd probably close somewhere here, right? And then I would not want to see this broken again. So possible retest, and then we need to break this. So we would have a high, low, higher high, and a break. So that would give you a breaker block, and then these candles would start that breaker block, and we'd be headed downwards. So the overarching high time frame analysis is certainly still in play here, and I'm only looking for shorts on the indices once I see anything like that. If we go to NQ, and I was drawing for my daughter, so I'm going to erase all this. And so again, on the NQ, right, we went to exactly 1 standard deviation up from this whole range. So it is currently a valid dealing range as well. So I'm going to redraw that dealing range here. And likewise, as on ES, we could see a sweep of this, and I'd want to see it again come right back in, a little test, and then a break of this low. So if this 1 standard projection is going to hold and be the high with this logical dealing range, then that would stay the dealing range, and it would just be a sweep of the dealing range high for liquidity, and then we're headed to the downside. In prior weeks, and so you could go look back at the analyses, there's reason to think that we might continue higher, but this again looks like I've established the rationale for why this looks like a long-term dealing range for now, And so I'd like to see a sweep of it and down if we are even going to. It's possible that this is a double top that will be left for later. And later, if markets tend to make all-time highs, so later can be really any time. But the less smooth I see here, the less smoothness I see here at the top, the more bearish I will be. So if we continue to leave these little equal highs, then I can't be as bearish as I want to be. And I tweeted about that too. If ES keeps leaving these relative equal highs on the way up, like it left it here, it left it here, it left it here, then I couldn't be full hog bearish. But you know, this is starting to see it, right? Again, this is where, if you're to draw a trend line that's saying, okay, if we were to continue bullish, this trend line probably should have held. And while this is an aggressive run up, right? So this would be a very aggressive trend line to hold to continue up. So we have broken that. So that's where it starts to begin to feel like we're going to consolidate and at least come into some discount here over the next several months. This steepness of a trend rarely continues for very long. I mean, you can even on a lower time frame, right? On a 1 hour time frame, if you were to draw this trend line and say, okay, look, it's a very aggressive run up on this trend line. Well, look at what happened. You come all the way back to a discount after this very aggressive trend line run up, and we did have a inversion fair value gap, a test, and down, right? And so I'm not going to get into the nitty-gritty of this dealing range as it formed and what would have caused it, but this is about the 25, 50, 75 for the final launch point, and here then we had a liquidity sweep back below it, and we're dumping to discount. So again, zooming out to the daily time frame, then we could certainly be seeing that same thing play out where we have a steep trend that has now been broken at a logical dealing range extension point and a sweep and going down to a discount. On the Dow, I was really hoping that the Dow could just consolidate here and keep this relatively sloped. This looked too clean though, and I was just watching in expectation as it plowed through it and took this high. And we closed right at the high. I still have my alert here up at 51.5, which was where I ultimately wanted to short the Dow from a while ago. Like when we were coming up here, I wanted to see it spike to 51 and then tank. So it actually is not too bad. This is the first market maker buy model that is going to turn into the second of a double top in the market maker sell model as we continue downward. And as bearish as I'm talking about it, yes, there is certainly a possibility that the US indices just continue to the upside. And that is absolutely a possibility. Permabulls will say, you're being too bearish. What are you doing? Well, I'm just looking at the math on these ranges and the global economic crises that seem to be happening with currencies, with commodities, and the entire Middle East situation. So it doesn't feel like people are going to be wanting to be in risk assets like very inflated U.S. equities that these prices are. So if we do pump up to 51.5 and this alert triggers, I will be again shorting. I'm really only looking for shorts. This buy sequence was not a surprise necessarily, but I didn't quite want to see it do that. But once we saw this consolidation, I pretty much knew we were shooting for the top, and I want to see this potentially spike a little bit higher with NQ and ES, maybe taking that high out as well. It's going to be a stronger bearish signal if they do. Often the second high will form the breaker, and the first high, if it does hold, then one of the assets could form a failure swing. If all three indices are going to make a breaker, that's not necessarily a continued bullish sign. There doesn't have to be a divergence, as many of my people that I've followed and included in my trading framework have noted. You don't need SMT divergence, correlated asset divergence, to to validate a trade idea. You just, I mean, that it is a nice confluence, and it happens in most scenarios, but it doesn't have to. So if all three indices are going to take the prior liquidity before a dump, then that is completely acceptable. Okay, and finally Bitcoin. So Bitcoin, this is what we drew last week. We're just possibly headed down, and I'm still very bearish on Bitcoin. I did want to see more of a push to premium, but it appears that we could be headed down if the indices, if gold, if oil's gonna dip, if gold's gonna go up, silver up for just a little bit, you know, maybe we do get a take of this high to form a bit more of a breaker pattern to head to the downside. But zooming out again on Bitcoin, at least we got into the premium of this dealing range, and of the parent dealing range we still haven't gotten into the upper third. Well, really we're right at the third mark here. So it's possible that this was the top, but usually we'll see a retest and then down. This is weekly, so again that may be it. We did engulf on the weekly, but that doesn't necessarily mean we're not going to retest it. We engulf plenty of other times and it gets blown out. That's not a valid analysis. What we do have here though is potentially the setup of 50% of a dealing range with this false support. It could run up here, possibly. If it's again getting up to here where this had barely a wick, there is still some premium gap up there. I am seeing this, and you're like, why are you picking this gap out? Well, sometimes, right, this is going to be above the super premium of this dealing range. So this dealing range, the extreme premium at 75, there was this gap, and that's basically exactly where we launched down from. So when you have a candle that starts an entire run like this, if you want to go back test this, it's very interesting. You might find that the candle that breaks the structure like this will often, actually more often than not, get a retest at least to wick the body of it, if not a complete wick of the entire candle. So it will liquidate the entire candle that broke the structure before it continues down. So again, this leg up is the beginning of the dealing range. That was the stop run of all this liquidity back here. So then once we break that down and this began the next one, we're in this dealing range. This hyper premium is likely to get revisited and fill more orders that really were resting here to knock everybody that's long out of the market, reestablish shorts, and head down. So I actually am looking for something more like this on Bitcoin, which would be, for me, an ultra bearish signal if we can get a run up here and then down. So I would love to see that on Bitcoin. I don't think it's really just going to tank from here. I do think we did what we did last week, and we could take a run up here. Now, if that were to be the next mini dealing range, something like that, we can start to see, yeah, so this makes sense. Again, we had a launch point from the 75, we had a consolidation and a launch from the 50. Here we had resistance at the hyper premium, came back to the 50, so we could be seeing a, eventually a false support. Right now it is support. If we do end up getting up here, consolidate, consolidate, blast off from the 75 into the what I would expect to be the apex of this smaller dealing range to liquidate this candle, then we can be coming down. So this 50% right now it held. We took some liquidity with this wick and kind of tapped the top of this candle, and I think my analysis on Bitcoin would show us pushing up into the extreme premium of this dealing range, and then we can see a downward move. So that does it for this week's analysis. I hope you got some value from it. Again, tell me what your favorite pairs are, what your favorite analyses are. I can try to go more in depth on those or see if there's other ones you want me to look at. I'd be happy to include those in future videos or make shorter snippets to be a bit more digestible. But this was the overall for this week. And again, we have Memorial Day on Monday, so it's not going to be a super heavy trading day. So trade well and be patient and disciplined. All right, thanks.